Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be talking about flows for the conventional fund business. Mainly, we'll talk about ETFs a little bit off and on. For the week ended Wednesday, April 24th, 2013. Now, this was really a zero-sum week. We had interesting news come out with sluggish economic growth being reported, and then also we saw some good earnings reports, some bad earnings reports. So really, if we take a look at mutual funds, there was a zero as far as flows. A little bit on the plus side, but again, it's probably just a rounding area. Although we did see the S&P 500 actually put together about a 1.75% return in the last 3 days of trading that we were taking a look at. Well, let's take a closer look at the macro groups to see how that played out. If we see equity funds actually took in $1.1 billion. It's quite an economy when we start talking about ETFs. This is conventional funds again, ex-ETFs. We took a look at taxable bond funds. Good number, really big number for them, $3.4 billion net new money into their coffers. And muni bond funds, they continued on their negative ways, just a little bit over $100 million of money leaving their coffers. And then, of course, money market funds saw about $4.4 billion roll out of their coffers. And while we're taking a look at this is kind of the interesting thing about it. You add those numbers up, and again, we're just a little bit on the plus side, but it really was a net zero. Had we taken in just, taken all the universe in there, we would actually seen about $7 billion of outflows. This is something we'll talk about as we go on to this next section as we take a look at equity funds. Equity funds actually saw a pretty surprising return. Remember I told you S&P 500 at 1.75. Well, mutual funds actually put up 2.19% return. And this is the second week in three that we've actually seen plus side returns. And $1.1 billion came into the coffers. This is the 16th consecutive week we've seen flows into this group. Year to date, we're actually at a phenomenal number, $91.8 billion. Well, where we saw kind of the money flowing out was domestic equity funds, people a little bit scared in that area. $171 million was all we saw leave the coffers. This is the first week in 10 they've witnessed actually outflows. And if we take a look at non-domestic equity funds, we saw $1.3 billion in net new money, 18th consecutive week of inflows for that group. And emerging market funds saw about $451 million net new money. Interesting, if we took a look at the equity income funds category, equity income funds actually saw a pretty good number, about $1.3 billion. And it turned out there was a merger out of a capital appreciation fund into an equity income fund that accounted for about $840 million of that money actually rolling in. So if you're taking a look and counting on your fingers and toes to figure out what the flows were, still strong flows in equity income funds, but again, I would discount it this week and move on to other pastures where we saw emerging markets actually taking about 451 of that $1.3 billion into world equity funds. Well, let's take a look though at the ETF side of the universe, and this is where I was saying we had a tale of two cities. This is for the fifth consecutive week out of fifth week out of six that we've seen outflows from this group. $8.4 billion. This is the largest outflow we've seen since July 25th, 2012. And of course, we're not going to be surprised by seeing SPY at the very bottom, $2.8 billion, followed by Spider Gold, $1.9 billion, and iShares Russell 2000, $1.5. These have been popular asset classes for people to get into. And when there's been a great deal of uncertainty, like there is right now, people kind of off and on, they're taking money off the table. We're not surprised to see big outflows out of this group. One of the areas, though, that we were surprised to see was when we took a look at the iShares MSCI Japanese fund. Japanese funds have been actually on a tear here as of late. $530 million in net new money into this group, and this is kind of one of those things that we've been keeping an eye on. Also, if you take a look at the group as far as inflows go, we see that it was kind of defensive. So we have Japanese funds, a defensive health biotech fund, and then another Japanese funds as well at the top. So this has been kind of a story. Japanese funds on a roll, and people are becoming a little bit more defensive with some of the concerns out there in the market and doing more in the health biotechnology area, and particularly in health sector. Well, let's take a look at an area that actually took in a great deal of money, and that's our fixed income universe. Fixed income funds, basically people were investing that based on yield. It's a 25th consecutive week. This group has actually seen net new money coming into their coffers, $3.4 billion. It's the first week in six that we actually saw a minus sign, 0.03% negative return, and so it's just about zero as well. But we've been actually seeing some pretty good numbers. But investors again fleeing, if you will, from the equity universe, decided to go into corporate investment grade debt funds for about $1.7 billion. And of that, when we take a look at it, loan participation funds really accounted for about $800 million of it. And then this is the 45th consecutive week both for corporate investment grade debt and loan participation funds as far as net new money coming into their coffers. Another big group that took in money were the flexible income fund group, and flexible funds actually took in about $1.1 billion. So now if we take a look at the ETF universe universe is a little bit different. And this is one of the areas that's been picking up some good steam. $1.4 billion of net new money coming into this is the sixth consecutive week that we've actually seen net inflows. And really one of the primary areas, and we've talked about this over a couple times, has been the loan participation funds. So we see PowerShare's senior loan fund taking about $310 million. This is their best inflow since they started in 2011. So there's really some good flows into there. Obviously, we saw some safety plays. iShares, Barclays, 7 to 10 Treasury, took in some money, and now it's about $200 million. But at the bottom, we kind of see a mixture of plays. Some of it's safe, some of it's shorter term duration, but we do see tips at the very bottom, and this has been a trend we've been seeing for quite some time. So while people are making bets on loan participation funds that interest rates will go up, they're not really thinking that inflation is going to be the problem. It's going to be actually push up on the interest rates themselves. So again, tips been taking outflows, loan participation, adjustable rate loan funds are basically taking inflows. Well, let's take a look now at municipal bond funds. This is the sixth consecutive week that they've had plus side performance. Granted, it was only 0.01%, but again, 6 consecutive weeks of plus side performance and the 8th consecutive week of outflows. Go figure. $109 million were outflows, but if we take a look, there was actually a change in kind of the presentation. National munis actually took in about $9 million, so they are on the plus side. So single state funds were really the cause of this $109 million. A lot of this is almost close to rounding errors, to be honest with you folks. Well, let's take another look at money market funds, and this is where we've been seeing some big outflows occurring as of late. $4.4 billion, the third consecutive week that we've seen outflows. Taxable money market funds actually had inflows, $0.9 billion, just a little bit under $1 billion. And this is how it broke up. Institutional funds saw about $2.6 billion in net new money come in versus the retail, which actually took money out, $1.7 billion. So when we take a look at it, it looks like the institutional investors are trying to find a place to sit on the sidelines, watch to see what's going on, and institutional investors, as we saw with the domestic and equity funds, with the inflows, basically putting money back to work. So they're taking money out of money market funds. And the last piece we saw, and this is where the big outflows came, tax-exempt money markets saw $5.3 billion of outflows during the week. So that was kind of the big news. Well, really, so I said it was a zero-sum game. I think people are going to be in the zero-sum game attitude for quite some time. Earnings season is here. The last time we looked, there was probably, I think it was over 160 odd funds that have already, or stocks that have already reported for the S&P 500. I think the number is actually quite a bit higher today. This was actually as of Wednesday that I'm quoting. But basically about 70% beat their expectations, but had poor earnings guidance and poor earnings reports. And so this has been a kind of a concern going on. And also I think people are going to keep an eye on employment. So as we go, sure, economics is going to be a very important issue, but again, people are going to keep an eye on earnings. That's going to be the key thing for the next couple of weeks. And then of course, as we get closer to month end, they'll want to take a look at the unemployment rate. Well, if you want to take a deeper dive and see what areas of yours actually attracted net new money or actually saw net new money flow out their coffers, go to our site at www.lipperusfundflows.com. If not, join us next week where one of our analysts will talk about the fund flows trends for that week. Until next week, my name is Tom Rosine, wishing the best in your wealth planning and creation.